In this video, we'll discuss basic business entity planning. Now, this is a really interesting topic. We're going to be talking about why somebody might consider choosing a C corporation versus an S corporation versus an LLC when they initially start a business, or they can change later on with respect to tax reasons. Now, I'm sure you've probably considered business law or legal reasons why you might consider one or the other, but these are really the big three: C Corp, S Corp, LLC when it comes to starting a business. And we're going to go through, again, the tax consequences. Now, I recommend, even though this is a basic level discussion, I really recommend that when going through this, have a firm understanding of the rules that apply to C corporations, S corporations, LLCs. So what this really does is it brings all of your knowledge of C corporations, S corporations, LLCs together, and by using that knowledge, then we can consider, okay, would it make sense to, or what advantages does one have over another with respect to tax consequences? If you forgot about the specific tax consequences with respect to C Corps, S Corps, LLCs, I have some basic videos that you can watch that help you guide you through the rules, the taxation of those entities. So first, we're going to start by talking about C corporations, and then we're going to look specifically at S Corps versus LLCs. So you see here on the screen, I have C Corp, and then below that I have S Corp LLC. And with the S Corp LLC, I have a bunch of different tax reasons or issues that populate or come up that involve, okay, well, which entity might have an advantage or preference over the other. So C corporation has its own discussion. And the reason that C corporation has its own discussion is because you should always start by asking, should a client be a C corporation? If they're not going to be a C corporation, then the question really becomes, does an S corporation make more sense or an LLC? And I'll tell you right now that most businesses, with respect to tax, the type of business that you want to use for legal and tax purposes usually is an S Corp or LLC, but there are certain cases where a C Corp makes sense. Now, before we go into business entity choice, business entity planning, picking between a C corporation, S corporation, and LLC, and looking at the tax consequences and tax issues involved, I want to make the point about the Tax Cuts and Jobs Act of 2017. So before the Tax Cuts and Jobs Act of 2017, it was even more clear that a C corporation was not really the entity to choose, because it was just so obvious the S corporation and LLC were such a better entity when you looked at double taxation and whatnot. After the Tax Cuts and Jobs Act of 2017, the corporate tax rate was lowered, and it became more of an issue that the C corporation actually was a player. But the Tax Cuts and Jobs Act of 2017 also brought about a new provision that we never have seen in the tax law, and that was the Qualified Business Income Deduction, Section 199A, which deals with pass-through entities providing a potential deduction. And that's really important. I have some videos on that discussion, because before we didn't have that, S Corp and LLC, you can get that deduction. C Corporation, you cannot. So it really becomes now, when you're determining between a C Corporation, S Corporation, LLC, that first question of whether someone should be a C Corporation versus the other two, which is always how I structure my business entity choice, it really comes down to more of, it's really even more, you got to drill down into the actual company than before the Tax Cuts and Jobs Act of 2017. Before, it was, okay, there's a few limited times where you should start as a C corporation. Mainly if you have financing, issues with, you're going to keep money retained because it's at a lower rate than what it would be, allocated with respect to pass-through entities as corporations and LLCs. But with the Qualified Business Income Deduction, only certain businesses can get that deduction, and also it's quite limited based on wage, property limitations, and whatnot. So you really got to look at the specific company. So with that being said, again, it's possible to have a C corporation as your choice of entity, but still, a lot of times, a lot of businesses, they should still start with the S corporation or LLC, because some of the major advantages for starting as a C corporation, mainly financing from a tax standpoint or other reasons, you can always change from an S corporation or LLC to a C corporation later on. However, it's more difficult to do the opposite, because you do have to encounter some issues with double taxation potentially of the C corporation and getting rid of that. So that's just one thing I want to note, is that after the Tax Cuts and Jobs Act of 2017, there's still the same analysis that we're going through. You're going to see that we're going to talk about in a moment, but it's not as clear as it used to be where, okay, C Corporation is very limited. Now C Corporation, or I should say after the Tax Cuts and Jobs Act of 2017, C Corporation is much more of a player, and it is important, but you should still always start with the C Corporation as the first element, because then once you determine whether it should be a C Corporation or not, then you continue. If it's a C Corporation, you stop, you're a C Corporation. But if you're not a C Corporation, then you got to make the determination whether the entity should be an S Corp or LLC, because there are a lot of overall similarities of S Corps and LLCs, mainly the pass-through taxability, but there's a lot of small differences as well, and we're going to talk about those in this video, all right? So with that, let's go ahead and let's jump into it. So why do I have this, where we start with C Corporation and we eliminate it right off the beginning? Well, as you are aware, with respect to a C Corporation, it has a very, very, very powerful negative effect, and that is double taxation, right? Double taxation. Whenever you hear double taxation, you think of a lady screaming, right? Ah! I can't believe that, that this level of entity has double taxation, and the other entities, the S Corp and LLC, are both pass-throughs and have single level tax. And that's exactly what you should be thinking. A C Corporation should be used in very rare and special circumstances. So there's 4 main reasons why you might consider using a C Corporation over the other entities. And the first is that historically and currently at the time of this video, that the rates on C Corporations are lower, so the tax rates are lower than the rates for S Corporations and LLCs, because S Corporation and LLCs, they have a lower rate the way that they're taxed, all right? So C Corporations, the tax rate is lower. And the idea is that if the client plans to grow the business in the sense that they're not going to be pulling out money with respect to distributions or taking money out, and they're simply just trying to grow their business from $0 up to $10 million, and then maybe eventually, many years down the road, they're going to sell that business, well, the tax rates within the C Corporation are much less, and you don't have to worry about double taxation because the client's not going to be selling his or her shares of stock, and you don't have to worry about the taxation whether the C Corporation has to recognize with respect to distributed assets and whatnot. So the idea is that the tax rate is lower on retained earnings because that is the tax that is within the C Corporation. Okay? Now, one drawback with respect to this item is that with respect to losses, as I'm sure you're aware, again, because the understanding is that you have a little bit a grasp of the basic rules with respect to S Corps, LLCs, and C Corps, the losses are trapped in a C Corporation. But S Corps and LLCs, the losses can be passed through down to the owners. Now, there's some limitation on that because of passive activity loss rules and at-risk rules and the basis rules. But generally speaking, a C Corporation, if there's losses in the entity, you can carry back, carry forward, but the owners can't necessarily utilize that loss in that same year. So that's a real big issue. So an advantage is the tax rates if you plan on retaining the earnings and growing the company over time. Now, a caveat is that you got to be careful because there's the accumulated earnings tax as well as the personal holding companies tax. And Microsoft many years ago ran into this issue where they just kept growing their company, growing to billions of dollars. They weren't making any distributions, any dividends to their owners, and then they potentially were going to get hit with this accumulated earnings tax, and they had to make distributions. So that you got to pay attention to, but it's possible that your client, this will not be an issue. So the next reason why you might want to consider a C Corporation over S Corp and LLC is based on the timing of taxability. And it goes along with the first one. So the first one and the second one are together, but they are two different concepts. So timing of taxability. And this is an advantage. The idea is that if you recall, for the pass-through entities, the S Corp and the LLC, the income, losses, credits, deductions, they all get passed through to the owner, even if a distribution doesn't take place. We call that allocation, allocable items. With the C corporation, yes, the C corporation has a tax effect that they had to pay on, which again is at a lower rate than S corps and LLCs, but the timing of when the owner actually wants to make a distribution and be taxed on it, that second level of tax, that's up to the individual owner by selling stock, or if the owner of the stock has influence, they can determine, okay, I'm going to distribute this asset out to me or another owner. Okay, so that affects things because you might have a really bad year, you might have a really good year. The good year, you might be in a high tax bracket, and when you have to pay tax, guess what? You might potentially get hit in a higher tax bracket. You might be at a lower capital gains rate or a higher capital gains rate a certain year, or a lower ordinary income rate or a higher ordinary income rate based on certain circumstances. So you can actually control a bit the timing of the taxability of certain items. With an S corp or LLC, it's simply just allocated out. Now, and then when you sell your ownership interest in the S corp or LLC, the basis rules, the mechanism for providing for single level taxation, they already take that into account, so you can't really control as much as you can with the C corporation. So that's the second item. So the next item, the third item, is probably the main reason why some entities choose a C corporation over S corporation LLC, and that's financing. Now, I know what you're thinking, financing, well, is that a tax consideration or a non-tax consideration? And it's really both. It's really both. So financing. So the idea here is that if a business entity knows that it's going to get venture capital funding, a lot of venture capital funding comes from overseas and from tax-exempt organizations. Now, at the time of this video, overseas owners through venture capital, private equity firms. I'm sure you can think of some of the biggest private equity firms in the world, and they're so diverse, right? And they're out of, Italy, they're in Europe. There's some in the US as well, but they have investors from all over the world. And what happens, I'm just going to summarize this, is that if the owners of that venture capital fund are an S corp or LLC, they potentially could have international tax issues that are very bad for them, that potentially could capture all of their income. And basically what happens is that to get venture capital, the owners require, okay, you have to be a C corporation. You must be a C corporation. That's important because if you don't become a C corporation, it could potentially affect whether you actually do get the funding or not. Now, the other types of owners are the tax-exempt owners. A lot of state pension funds might be invested in a venture capital fund or whatnot, and they prefer to do business through a C corporation because, well, for tax-exempt organizations or tax-exempt type ownership, when you look at the taxability, being an owner in a C corporation has better advantages than S corp and LLC because of the unrelated business income rules. And that's all I'm going to say about that. You can look more at that and how it works, but the tax-exempt organizations, they prefer to be owning owners in a C corporation through their private equity venture capital funds than being through S corp or LLC. Now, another reason is because of going along with that, they also, usually venture capital funds prefer some type of equity preference like preferred stock, and while an LLC might provide for that, but again, it violates the rules I just mentioned about for international abroad owners, it affects international tax issues, and then for the tax-exempt owners, it affects that unrelated business income issue. So financing really can drive a huge portion of why you might be a C corp. Now, if you're advising clients, a lot of clients would go crazy, goo goo gaga over being able to get some venture capital fund. They really want to grow their company. So they might come to you optimistically and say, hey, I know I'm going to get venture capital funding. I want to start as a C corporation. Well, hold it right there, because you can actually start as an S corporation or LLC, and you can switch to a C corporation. And one of my good friends, a partner at a really big law firm in Boston, he's an excellent tax, and he has some rules. I'm going to talk about these rules, but one is called the crystal ball rule. The crystal ball rule. And the crystal ball rule says that sometimes clients, they think that they can see through the future. And as tax professionals, we know that we can't predict the future. We can't predict the future when it comes to the tax laws changing, certain things happening, certain business events, economic events, right? We could have downturns in the economy, going up, going down. I mean, we might have some predictions and whatnot, but we can't predict the future with respect to 100% accuracy. Clients sometimes think they can. And if a client comes in and says, I know I'm going to get venture capital funding, and in your mind you say, okay, well, if you know you're going to get venture capital funding, then guess what? Financing is probably an issue with respect to a C corporation. Well, you can't simply just go off that. You could potentially you can have an issue there with respect to liability, because that double taxation issue. And then the clients come back to you after they never get financing and they say, hey, why was I ever a C corporation? You costed me millions of dollars by double tax here. So you got to be careful. And one thing to note is that through planning, you can start off as an S corporation or LLC, which a lot of times is the way to go. And then you can always switch to a C corporation. So I just noticed that I forgot to put this C in here in financing. I apologize. Let me just fit that in right here. Oops. I know it's hard. As a teacher teaching a live class, students will correct me, say, hey, you misspelled something, or you forgot to put a letter in there. I will say, though, that, online, I try to make sure I keep up with this stuff. I apologize for that. Okay, so the final reason why a business entity might want to be a C corporation is there's special tax benefits, and they mainly apply to small C corporations, smaller C corporations. These include the small business stock rule and Section 1045 and Section 1202, which these things might have, when you're viewing this video, might not be there anymore. They might be. It really is a function of years. Sometimes the Section 1202 and Section 1045 rules, they go away and they come back. It really depends on what's going on. So there's certain special rules that actually could provide for benefits of being a C corporation, or they could at least lessen the tax issues and actually make it even better or at the same level as a pass-through entity. Certain times, Section 1202 and Section 1045, they allow for exclusion of up to a certain amount of gain or half the gain, but they usually apply to small C corporations. So that's really all there is about the C corporations. That last special rule, that usually doesn't drive it, but it might, if you're on the fence about being a C corporation over the other two, it might make a big difference. Okay, so now this is the good part, right? So pay attention, because now we're going to talk about why you would want to be an S corporation over an LLC, or an LLC over an S corporation. Because it really, if you're looking from a tax standpoint, it could make a difference with respect to certain things. So I want to go ahead and tell you up front that just like with respect to the crystal ball rule we just talked about, you don't know the future. Being an S corporation or LLC, you're going to see there's going to be advantages to one over the other with respect to certain items. Now you might be able in your mind to make, okay, I think the LLC is better, I think the S corporation is better because I value this specific item more than other items, and that's fair. That's a fair reason. But it really comes down to specific clients have specific needs. And I'm going to talk about that. I'm going to sum that up at the end through, again, some of the Jay Darby rules that he's kind of come up with. Interesting little quirky rules that really help you understand this. So the first item I want to talk about is formation and contribution. So again, if you have forgot really the basic ideas and the basic rules of S corporations and LLCs, I strongly encourage you to stop the video now and go back and watch some of my videos on S corporations and LLCs, what the general rules are. So if you remember, when we form an S corporation or an LLC, what were the rules that applied? So for the S corporation, we had Section 351, and that was the non-recognition rule that applied, but you had to have 80% or more ownership in the stock of the corporation. 80% or more. All right? For LLCs, and by the way, for the S corporations at 80% or more, that applied to not only you, but a group of individuals or owners. I should say individuals because it could be actual entities that own, right? Owners. So you can actually have a group that's considered, okay, if you, as long as before and after you look and 80% or more after, then when you compare to before, then that qualifies. And this also applies to contribution, by the way. So contribution is when an owner contributes down the road after it's been formed, which can be a lot more difficult. And the idea here is, what if you're transferring to the S corporation appreciated property that, okay, you're trading it or exchanging it, appreciated property for stock. Well, we have an exchange. So remember, section 1001, the realized gain or loss rules, boom, they're triggered, right? And if that could potentially have a recognized gain. So that's an exchange that you might have to recognize gain, but then we have that non-recognition rule. So you really want to get that non-recognition rule because again, the general premise in tax is that we want to defer gain and we want to accelerate losses and deductions. All right? LLCs, if you remember, section 721 applied, which there was no ownership requirement. It could be 0.000001% or it could be 99%. And this applies to both formation and contribution. So right there alone, the LLC, and I'm going to put a little check mark for whichever one that I feel is going to provides the benefit of the other. Some of these is a little bit harder, but the LLC is an obvious winner here. So the LLC has an advantage over the S corporations with respect to formation and contribution. Another reason, going further, just to give you a little bit more, I call this an intermediate level of when this makes a difference. What if the owner is contributing property that has losses? Oh, right, that's interesting. You thought about gains. Okay, well, yeah, it's easy for, LLC. But for losses, I will tell you that an LLC also has the benefit. So this rule, this benefit of which one's better, and by the way, remember, LLC, we're talking about subchapter K. The default rules for an LLC are going to be subchapter K, unless it's a single owner and then it's a flow-through entity. But let's assume that the LLC here has more than one owner, and you're applying the rules of subchapter K. Okay, more than one owner. For both of these, let's say, S Corp and the LLC, more than one owner. We're going to assume that in this. Okay, so again, I'm telling you that the LLC under section 721 in subchapter K, it's a benefit not only for gains but also losses. Think about it. Maybe do you know why? Take a second and think. Well, the reason is because if you recall, for corporations, C corporations, S corporations in section 351, what happens if you have a loss? You can never recognize a loss, even if you have boot. But for LLCs, if you have a loss, the general rule says no gain or loss can be recognized. But what if you have boot? What happens when you have boot? When you have boot in a corporation, you have to look at the lesser of the realized gain or loss, right? And the amount of boot. But remember, section 351B says in a 351 transaction, you can never recognize boot. So it stops any, boot. I apologize. Take that back. And in a section 351 transaction, right, that's me getting a little passionate here. Section 351, you can never recognize a loss, ever. But for an LLC, if you recall, when we have boot, the transaction is bifurcated into the non-recognition portion and the boot portion. So we look at the partnership interest and the boot received and the assets that are being transferred. We do a portion with respect to each. So we basically break the transaction in two parts. The portion with respect to the the LLC membership interest, the ownership interest, right? And the boot property. Well, you can't recognize a loss under section 721 with respect to the membership interest. But what about the portion with respect to of that loss with respect to the bifurcated boot? Well, guess what? You can recognize the loss. That's interesting, right? So you can actually potentially take losses. I'm going to put that down. You can take losses on formation or contribution of property. Loss potential. And that's huge because we love losses in tax, right? We love losses. That's loss potential right there, loss potential. Okay, so now we go to the number of owners. So if an S corporation, if you recall, in the rules, and this could change because certain times it's been 75 owners, other times it's been less than that. Currently, at the time of this video, it's 100 owners. It's not 75, it's 100. But there's a limit on the number of owners that an S corporation can have. Now, there's special rules with respect to attribution, like certain family members or business entities are viewed as, okay, a husband and wife, for example. If a husband and wife both own an S corporation, they're both treated as one owner for the 100. So you can have 100 or fewer. You can have no more than 100 owners. LLC, though, at the time this video was formed, there's no limit to the amount of owners. No limit. Now, I would say that practically speaking, if you have a lot of owners, that state might have some issues. But there's no limit. So right there, boom, we have another advantage for LLC. So far, it looks like the LLC is better, but hold on. S corporation is going to gain some momentum later on. Okay, type of ownership. So if you recall, S corporation can only have one type of stock. One type of stock. Now, you can have differences in voting, but you can't have differences with respect to, you got it, distribution. That's very important. So differences in voting is fine, but differences with respect to distribution is not fine because the whole idea, the main idea of preferred stock over common stock is that preferred stock, if you look at the liquidation line, when the company, let's say, goes bankrupt, who gets money first? Got creditors, bondholders, and then guess what? Preferred stock, and then common gets whatever's left. So some owners value that distribution preference because it's huge. And a lot of venture capital funds, they prefer that. For an LLC is the most flexible type of business entity out there. You can do all sorts of things. Jay Darby, he analogized an LLC to a 1957 Chevy. And for those of you out there that don't know about 1957 Chevy, 1957 Chevy, basically you could build your dreams on that car. You get the chassis, you could do whatever you want to that car. It was, customizable, you could do everything. The parts were great, it lasted a long time. It was very, 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 it had a lot of flexibility to do certain things. So if an LLC, there's very flexible types of ownership. You can have all different types of ownership. Some owners are going to get their money back before others. Especially, that's very important if you're somebody like Donald Trump that has tons of money and they're going in on a venture and they give all the money and then the other members of the LLC, maybe they just do service. Donald Trump wants to make sure he gets his money back before any of them do at the end. Very, very, very flexible in terms of the types of owners. So right there, boom, we got another one, LLC. So the poor S corporation is just sitting here and what's going on, right? Now, I will tell you that from a practical standpoint with S corporations, you can get around this rule with debt, but you don't want to really, it's potentially, you're going to have lots of planning issues, spend a lot with your accountants and lawyers doing that, and you potentially could run afoul of certain rules, and you don't want to do that. With an LLC, you won't. You're not going to have debt versus equity issues where it's recharacterized as equity, which that could potentially ruin it all for the S corporation, and boom, you get hit with C corporation double tax. So why not be safe and be the LLC? Okay, next one is flexible allocation. So what is the general rule in terms of allocation? So we're talking about allocation of profits and losses. Well, with S corporations, which remember, S corporation stands for Small Business Corporation. The idea is that it's pro rata, the number of shares. Pro rata number of shares. So let's say that you have 2 owners in an S corporation and there's 1,000 shares. If that's the case, and one owner owns 400 shares and the other owner owns 600 shares, and to make it simple, let's assume they both own the same number of shares during the entire taxable year. Well, the first owner owns 40%, 400 over 1,000, and the second owner owns 600 over 1,000, 60%. That's the only way you can allocate items during that year. LLC, though, if we have one owner that owns 40% and one owner that owns 60%, you can allocate profits, losses, all different types of ways. Again, very flexible. Now, the caveat to that, if you recall from the partnership rules, and this is why Subchapter K is one of the most difficult areas of not only the U.S. tax code, but all of the U.S. code, is the allocation must have substantial economic effect. And that's all about the economics of the deal. We might allocate all the losses to one partner and all the gains to another partner, but you better believe that's how economically it's allocated as well. If not, it's going to run afoul, and then it'll be allocated according to the partner's interest in the partnership, which here is members, so it'll be members' interest in the membership, right, of the LLC. And of course, if there's a limit on liability, LLC, all owners have limited liability. So, we're not. If you had a general partnership, that becomes an issue. By the way, C Corp, S Corp, LLC have all levels of limited liability. Now, whether one has more limited liability than others, that's another issue. Whether S Corp has more limited liability than LLC, I would argue under case law that might be correct because S Corps have been around longer, and that's why a lot of entities, they are LLCs, but they actually elect to be an S corporation status, which is interesting because, again, tax is not usually the issue that wags the tail of the business entity dog. It's usually limited liability or liability protection, asset protection. That's a huge thing. All right, let's move on to user friendly. This is one of my favorite things because if you recall, S corporations, small business corporations, and as you saw from the rules here, S corporations were really meant to be user-friendly ways to conduct business. So very user-friendly. What do I mean? So user-friendly in the sense that the tax returns are a lot more simple. When you have these pro rata allocations, okay, that's a lot more simple than the very flexible version. Now, it's possible that an LLC could be very simple as well if everything is just 50-50, not, that. It could be very simple. But generally speaking, S corporations, you got less owners, it's a lot more user-friendly, very friendly, and the tax returns, the filing. If you're hiring an accountant, it's going to be a lot more simple. You're going to probably pay less than an LLC, okay? LLCs can be friendly. It really depends. I'm going to say it depends here. And because this depends, now the more complex, it's going to be very, 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 could be complex, could not be complex. And because I already went ahead and gave you this check for the S corporation, sorry, I should have waited. But because it depends, it really goes to the S corporation here, I would say. I've seen a lot of LLCs that are drafted quite flexibly. And when the more flexibility, the more complex. The more flexibility, so the more flexible the arrangement, right, equals complex. So if you're doing loss profits to one member over another, you're starting to get into more complex rules. Okay, so look, we got 1 for S corporation and we got 4 for the LLC. So right now, and I will tell you that at this point, it looks like it's leaning in favor of the LLC. And at this point, yes, you would agree. But let's get to the self-employment tax. This is very interesting. So self-employment tax. We're talking about here taxation. Usually what we think of is compensation, right? You might be have wages and you have and you get taxed on that, your employment tax. As an owner of a business entity, you potentially could have you own the business. You potentially could be seen as an employee of the business. Now, if an S corporation, the general idea is that you are taxed on your compensation. On your compensation as when you do compensation as an owner. For the LLC, it's compensation and your distributive share. That's generally how it's seen. Now, there's a few caveats to this, but this is generally how it's seen. compensation, compensation and distributive share, which that potentially means your profits could be subject to self-employment tax. Put distribution. Should be distributive share. Distributive share is what we think of the items that are allocated to you during the year. So this is a huge reason why you'll see a lot of entities actually formed as an S corporation. This is a huge reason. This is big. This is a big thing. I'm going to say this is big. So at this point, obviously the self-employment tax goes to the S corporation over the LLC. Now, this can depend on certain types of arrangements. Again, it could depend, but I will say overall, it's going to go to the S corporation. Could be equal in certain cases, but S corporation, usually case. This is why a lot of accountants pick the S corporation over LLC, just for this reason alone. And I don't blame them. I'm an accountant. I'm an attorney. This is a pretty good reason why you might decide to go with the S corporation over the LLC. Okay, so now I want to go to some of the things that you probably might not have heard about or thought about. The ones above, I will say you probably have heard about these, but you still got to consider these. And again, it really comes down to the client's needs and what the client, what you think, you got to talk to the client about their plans. They might just plan on growing the company and selling it after 30 years. They might only plan on selling it after 2 or 3 years. By the way, if you're going to sell the company after 2 or 3 years, you definitely don't want to be a C corporation, regardless of the tax rates and the timing of taxability and all that stuff. All right. So timing of distribution. So we're talking about distributions. So let's say that a business entity is going to distribute twice during the year, on June 30th and December 31st. Going to do 2 distributions during the year. Well, for an S corporation, all distributions are taken into account at year end, regardless when they happen. And why does this matter? It's all about timing. Timing is my favorite topic in tax, and it's one of the most important aspects in tax. So if you think about it, when you think of the distribution rules that apply to both S corps and LLCs, they're both very similar. We take into account income, and we take into account income when we increase basis by income, right? When you're looking at, okay, the effect of that distributive share that's allocable. That income and gain that we have, that increases the basis. Any losses and deductions, those decrease the basis. And we do this at the end of the year, right? We do this at the end of the year. That's general rule. Well, a distribution always comes, we always look at that after. Distributions, they reduce basis, right? And you can only take distributions, the amount of a distribution beyond the basis of an S corporation LLC results in gain. Capital gain, but still gain. Important. Very important. Because with the S corp, all distributions, whether it's the June 30th in my example or the December 31st, are deemed to occur on December 31st after we increase basis for the income and decrease for the losses and deductions. For an LLC, if we have the same business entity that has a distribution on June 30th and December 31st, we don't consider all distributions at the end of the year. We consider them at the date they occur. Distributions are considered at the date they occur. So distributions for LLC are considered at the date they occur. So that would be on June 30th. It would be as a distribution on June 30th. At date occur. So the idea here is you have to determine, and you do this at the end of the year, but you still have to determine what is the amount of income up to that point, what is the amount of loss and deductions up to that point on June 30th, and that's going to affect the basis, and then you take into account the distribution, but all of that's done as of that date, June 30th. And then you do the same on December 31st. Now that could potentially create an issue because what if you have a lot of income in a year that increases the basis and you don't have enough to cover the distribution on June 30th, but you would have if you did the whole year's amount of income and you looked at both distributions at the end of the year. Well, in that case, the S corporation would be an advantage because you wouldn't recognize any gain. Would you rather have gain during a year and more basis? Or would you rather have no gain during the year and less basis? Again, situation 1, gain during the year and more basis. Situation 2, no gain during the year and less basis. Well, I'd rather have number 2 because remember, the general idea in tax is that taxpayers almost always prefer to defer income and gain recognition until the future and accelerate losses and deductions today. So that means you want to push the income until the future. I mean, now there's exceptions to that, but that's the general idea. So all distributions are viewed at year end for S corporations, and if you have income, that's good. If you have losses for the LLC, then for the year, if you have losses for the year, it's still viewed during that year, so there's no effect to the S corporation. See how that works? You view them all at that point. Okay? You don't get the loss. It's just going to be, okay, the distribution is not taxable. It reduces basis down. But if you potentially have gain, that's bad. So that's why I'm saying that the timing of distribution for S corporation is better because gains have more of an effect than losses do. Yeah, losses could potentially affect the basis. Gains can too, but it could potentially have income for the year. The only way you can have losses with an S corporation or LLC is through allocation, as well as through if you sell the business, okay, or you could sell your ownership interest. But that's not what distribution does. All right, unless it's a distribution at the end of the you're liquidating the business and then you distribute, which is not what I'm assuming here. We're going to talk about liquidation later. So got that? So right now, look, we had 4 LLC and 3, and again, that self-employment tax is a big one. Okay, effective liabilities. So what are we talking about here? What if the S corporation or LLC takes on debt, or you or a partner comes to the partnership, to the LLC, or a member comes to the LLC with property, and the other owners have to assume part of that. Well, if an S corporation, if you recall, liabilities do not go into the basis of the stock, not in basis of ownership. Now, there's one exception for that, but it still doesn't go into the basis of the ownership. It has its own basis. And that's when an owner of an S corporation personally guarantees a loan or personally makes a loan to the S corporation. And what happens is you have your basis in your S corporation stock and you have your basis in the loan. 2 separate, and it creates all sorts of ordering rules. An LLC, though, liabilities are allocated a certain way based on economic risk of loss, and liabilities do go in the basis, are in the basis of ownership. This is huge. This is another big reason, a big idea here. I know I haven't spread out. Self-employment, effective liabilities. This is obvious that the LLC is going to create the advantage. Why? Because you have a greater basis, which reduces any possibility for gains when you have distributions or when you sell the business. S corporations, you don't get to take into account any liabilities the S corporation takes on. Now, the reason for that is economically, that's how it is. But for LLCs, we have to do this anti-abuse economic risk of loss test. That's why. S corporations or corporations, as you know from my previous videos, the difference between a C corporation and S corporation is not a difference under state law. It's a difference under federal tax law. When you're a corporation under state law. The difference between C and S corporation for federal tax purposes is just the letter in front. No, I'm kidding. It is the letter in front. One's a small business corporation you must elect, but it does create the main difference is one level of taxation. Okay, so the effective liabilities is huge because, again, it could potentially affect your potential gain situation with distributions and selling the business and whatnot. Okay, distribution of assets. So this one is very interesting. This is an interesting one. When an S corporation distributes assets, it's possible So let me go back here because this one's a little bit hard to understand. Again, if you're getting a little lost here in the presentation because you kind of forgot the rules of S corporations versus LLCs, I really strongly recommend, at least at this point, to go back and review that because this one's a little bit, you got to kind of think about this one. This is one that I really enjoy because I like getting down to these little puzzle pieces like this. You know, the really intricate puzzle pieces. So let me start with an LLC. It's going to make better sense of an LLC. So let's go about this a different way. Let's say you have two owners of an LLC. And let's say they're both 50-50 owners. And owner one is going to give $100,000 in cash, invest $100,000 in cash for 50% ownership interest. Owner two is going to give a piece of land worth $100,000, but it has a basis of $20,000, so it's appreciated property. What happens if the LLC later on down the line distributes owner two's land to owner one? Well, we have special rules. We have pre-contribution gain and loss for anti-abuse. Pre-contribution gain or loss that can trigger the other partner having to recognize gain or loss. What happens if that same situation happens in an S corporation? Well, think about it. Think about the corporate rules. I'll give you a hint. That one rule, the first level, so you got to think of it as the distribution rules. Remember, if you go back to my videos, I have a bunch of steps you got to go through. The first step when you have a distribution is you got to look at the corporation. Applies to both C and S corporations. Are we distributing appreciated property? Yes. So what happens? The S corporation is going to have to recognize gain, and it's going to be allocated to the partners according to their pro rata share. So the pre-contribution gain or loss with respect to the LLC goes to that partner, that contributes. Or I'm going to say partner here because of subchapter K, member. Partner that contributes. It all gets allocated there. Anything beyond, let's say that we go from $20,000, again, that's what the partner two contributed the basis, and it went to $100,000, it went up to $150,000. Well, the $50,000 increase from $100,000 value at contribution up to the date of the actual distribution out to partner one, or any partner for that sake, that's viewed as $50,000 that happened while in the LLC or partnership. That's going to be allocated between or among the partners or owners, members, right? So partner two, even though partner one gets the property, is going to be allocated gain of the $80,000 pre-contribution gain, the difference of the $100,000 value of contribution minus the $20,000 gain. I'm sorry, $20,000 basis when contributed. $80,000 goes to that partner. Okay? Well, in an S corporation, we allocate everything using our rules. So the corporation, for simplicity, let's just go back to our previous example and say, okay, what if the value just stated $100,000? Well, partner two would be allocated all $80,000 under pre-contribution rules, under the pre-contribution rules, okay? But if an S corporation occurred, guess what happens? S corporation recognizes $80,000 in gain, and it's allocated. There is no pre-contribution gain or loss. It's allocated based on the pro rata allocation rules. The pro rata allocation rules. So owner number one would be allocated $40,000, one half, again, because they're both 50% owners, of that $80,000 gain the partner or the S corporation had, and owner number two, which is the original owner, right, that had that pre-contribution gain, all $80,000 in the LLC example, would be $40,000 as well. This creates a different result. Do you see that? It creates a different result. And then the partner, I'm sorry, I keep saying partner, the owner that gets the property, we got to look at, okay, the distribution rules, all that stuff. You got to go through all that stuff, but it's possible that if it's not it's going to be allocated to the partner, and you look at the owner based on, you look at the basis. And remember, distribution is viewed at the end of the year, so the gain from that $40,000 will increase first, increase up, and if there's $40,000 of basis by that partner or owner already in the basis, then there's not going to be any additional. They're going to have gain there from the $40,000, but they're not going to have the full $80,000. So this potentially could be a benefit. I think it's a benefit for the S corporation. Okay, and you got to go through that again. So let me just summarize it again. With an LLC, let's just say again that one of the owners, owner 2, contributed pre-contribution gain property, land, 100,000 value, 20,000 basis. Let's say let's say the land after 2 years didn't go up in value, stayed like that, and the basis is still $20,000. Let's say the LLC distributes that property to member 1, the owner number 1. So owner 1 takes it. Guess what happens? All of the $80,000 gain, 100,000 value minus 20,000 basis at the time contributed, right? Because remember, on contribution, the LLC takes a carryover basis of what partner 2 had. All $80,000 is allocated to partner 2, even though partner 1 gets it. All right? Even though partner 1 gets that. Because that gain was inherent in the property. It's only fair because guess what? Because owner 1 brought in cash that had no difference in gain. The idea there is we have this rule because maybe owner 1 is at a lower bracket, and this is the anti-abuse rule. So by basically people were trying to do this because they were trying to shift their property from one owner to the other, and this would save taxes. Owner 1 might be in a 20% tax bracket. Owner 2 might be in a 40% tax bracket. By doing this, it potentially could save in taxes. Now, if we did the same transaction of an S corporation, the $80,000 gain would be recognized by S corporation and distributed out to owner 1, owner 2, half-half, because they're half owners, $40,000, $40,000. So they each have to pay tax on $40,000 of gain. But owner 1 is the one getting the property, so we got to go through our distribution rules for S corporation. We don't look at earnings and profits because, by the way, in this video, we're assuming the S corporation was always an S corporation. If it's a C corporation and then goes to an S corporation, then that's a bunch of can of worms that you got to consider. That's advanced business entity planning. Okay? But the idea there is, let's say that owner 1's basis is $100,000, which it was because owner 1 contributed $100,000. Well, let's assume there was no other basis adjustments in year 1 and 2. So because we viewed the distribution at the end of the year, 12/31, we first increased the basis by the $40,000 gain by the land that was distributed out, the land that owner 2 originally contributed, right? And then guess what happens? Basis goes from 100 to 140. Then we look at the value of the property being distributed. It's 100,000, right? 100,000 value. We look at the basis. It reduces the basis down from 140 down to $40,000, and the partner takes the basis in the land at $100,000. See how that happens? Guess who doesn't have any tax effect? Well, I'm sorry. Instead, in an LLC example, partner or member number 1 had no tax effect. Member 2 had to take all the gain. In the S corporation example, both had $40,000 of gain. So see how that difference? And if member 1 is at a lower tax bracket, 20%, and member 2 or owner 2 is in a 40% bracket, this obviously, the net tax result of S corporation is going to be lower. So that can create an advantage if you think about things that can be done economically. And maybe, I know this sounds a little crazy, but maybe if an S corporation is formed, this does happen. Guess who might pay something on the side over to the other owner? Owner 2 might pay on the side some money to owner 1 and say, hey, if you do an S corporation, I can do this and I can avoid potentially some tax. See that? Interesting, right? Very interesting example. Now, I can see the IRS having an issue with that. All right, liquidation. So when the partner, I'm sorry, when the entity liquidates, which entity is going to have better results? So this one, I'm going to summarize because this can actually be quite, you got to go through a lot of things to actually, when you have liquidation. All right. So in liquidation, we're assuming the assets. The assets are being liquidated. So on liquidation, if there's lots of inherent gain, the S corporation is going to have to recognize that, and then guess what? It goes to those owners, just like we saw in the previous example. All right, because when the S corporation liquidates, it's like a sale of assets. You can do sale of stock too, but let's assume this is a liquidation of assets in both of these. This creates lots of potential gain. Now, through other measures, mainly the increase in the basis of the stock ownership, you might have a loss through the sale of the stock for the amount of money you're getting. Okay? So you can have a gain and loss, but it could be offsetting in different years. There's all sorts of issues that you can see here with liquidation of assets. For an LLC, though, if you recall Section 731 of an LLC, what generally happens is a partnership can liquidate and distribute its appreciated assets tax-free in most cases under Section 731. Okay? And the reason that is because when an asset's distributed out through liquidation, well, guess what happens? You look at the basis, and if there's enough basis, the basis can be allocated out. So what happens is on liquidation of assets for an S corporation, the basis of those assets will be fair market value. But for an LLC, what ends up happening is no gain, but the basis carries over. So fair market value adjusted basis for the S corporation, but for the LLC, there's no gain, but it's a carryover adjusted basis in the property. Consider, again, the distribution rules for partnerships, LLCs. What would you rather have? Would you rather have gain today and a higher basis, or no gain and a lower basis today? So situation one, gain today, higher basis, or in the property you're getting, or no gain today and a lower basis. Well, we already talked about this. I'd rather have situation two. It's all about, again, taxpayers prefer to defer income recognition if they can. All right, so far we have some advantages for S corporations, 1, 2, 3, 4, and we have 1, liquidations benefit, 2, effective liabilities, which that's a big one, 3, flexible allocation, 4, type of ownership, 5, no limit, and 6, LLC. So we're 4 to 6, is that what we saw? Yeah, 1, 2, 3, 4, to 1, 2, 3, 4, 5, 6. So the last one's tax-free reorganization. So there's certain tax-free events that can occur through mergers and acquisition. Now, it's possible to do this with an LLC, but S corporations and C corporations have special tax-free reorganization rules. Special rules. We have A-type reorgs, B-type reorgs, C-type reorgs, D-type reorgs, and a bunch of other ones, E, F, and there's others as well. We have reverse triangular mergers, forward triangular mergers. There's so many different special rules. LLCs, it's possible to do. It's possible, given certain circumstances, to have some type of arrangement where someone comes in and acquires your business, and maybe it merges, or it becomes part of a business, and it's tax-free a certain way if you've done things the right way. But it's very, very, very difficult to do it that way, and you have to have certain things the right way. I've seen it done, but it's very tough. With the reorganization rules that only apply to corporations, not LLCs and partnerships, it's very, very, very flexible. It provides more flexibility. Now, the general idea is that the tax-free reorganization rules, and you'll see with LLC as well, is that you're getting a transfer in with respect to ownership interests. So let's say that Corporation A wants to purchase Corporation B. Well, Corporation B, to have a tax-free reorganization where they're not going to have to recognize gain, they would have to get a lot of the consideration in stock in Corporation A. Stock, they could get some some payment of cash or other property, but it's going to be limited. All right? It's going to be limited. So that's one thing I want to mention. So look at that. We're at 6, 1, 2, 3, 4, 5, 6. The liquidation one's over here. Sorry, for LLCs. 2, 1, 2, 3, 4, 5 for S corps. Now, depending on what you view, you might view that self-employment tax as huge. That might trump the LLC. It really does depend on your type of business entity in the specific situation. Now, the last thing I want to leave you with in this video, and I hope you've enjoyed this video, is that there are some, again, going back to Jay Darby, I know he's great. He has some special coined phrases that he's talked about. And the first thing I want to mention is the blue jeans rule. The blue jeans rule applies to S corporations. And as you've seen, if you are advising a client that is not very sophisticated, doesn't have very sophisticated structure, typical small business, maybe just 1, 2 owners, and they don't care about pro rata shares, there's not going to have a number limit, they don't care about preferences, formation contribution, they're all going to contribute, they're all going to form at the same time, then it's probably best to go with the blue jeans rule, which says be an S corporation. And the idea here is it's this user-friendly. They're not going to have to pay an accountant to do the crazy tax returns and do the allocations and all that stuff that you would have to do under substantial economic effect. It's just wise. It saves money for the client, and it's just about a simplicity. LLC, though, as you've seen, there's a lot of flexibility involved. And this is the accountant and the natural business deal rule. Natural business deal. So I'll just say natural business. So this is a rule, accountant and the natural business deal rule. So the accountant rule says that if you go and meet a client and they probably have an accountant with them or some type of attorney, tax professional that knows what they're doing, they probably want to be an LLC because they probably want to make sure they have flexibility with ownership, flexibility in allocation, or at least they have someone else in there that's interested in that. All right. The natural business deal rule says that if you have certain clients that come in and they're contributing money, and other clients that are going to be or not your clients, but other owners are going to be doing services. Well, it makes sense to have a more flexible arrangement with certain parameters because of the natural business. Economically, what's going on? Well, I'm contributing money, but I want that money back first before the other people get their share of money. And that's really the idea here, is that as you saw from this, again, it really does depend on the specific client and their needs. If you go through all these, again, we can't determine whether S Corp or LLC is better. I mean, personally, I think the LLC is better because I like the flexibility, but I could definitely see an S Corp being preferable when you view the blue jeans rule for certain small businesses. Maybe just, you see someone that has an auto mechanic, they have their business. They just have they don't have a very sophisticated financial structure, sophisticated legal structure, whatnot. S Corp be perfect. So I hope you've enjoyed this video, and it really makes you think about not only basic business entity planning, but this also helps you understand actually the rules that you've learned about C corporations, S corporations, LLC, and how they play out. This is a very interactive approach to learning not only about these different types of business entities, but also just about the rules of taxation with respect to these entities themselves. So I hope you've enjoyed this.